Hello and welcome everyone to MetaStock's International Market Roundup. My name is Hunter Smith. Today is Friday the 13th. We were all scared before today was Friday the 13th because of what the market's been doing recently. Let's get right into that in just a second. First off, I have to go over the legal portion of things. This demonstration is designed to instruct you on using MetaStock and accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of our software, any trading strategies, or information. Now that we have the legal stuff out of the way, let's get started. Today's guest for our international market recap is Giles Coghlan. He is a commentary analyst at Forex Source. We've actually been working with Forex Source for quite some time now. Have his bio up there on the screen. Let's actually go ahead and bring him in here. Giles, can you hear me okay?
Yeah, I can hear you fine, Hunter. Good to see you.
Good to see you as well. So the market's been burning for a couple of weeks now. When's it going to stop?
That is the question, and I think the answer to that question, Hunter, is it's going to stop when the spread of the coronavirus is in the rearview mirror. At the moment, it's like a juggernaut that's just coming towards the Western world, and everyone is scrambling for the exits, which is why we've seen such extreme moves across so many asset classes during this last week.
Yeah, it's been ridiculous. The Dow has lost 6,200 points within the last 3 weeks. We've had a couple of shining spots, a couple of points in which we had slight consolidation, a slight move up, and then literally the bottom just falls out the next day. And I'm scared for Monday because, again, today we have a 1,900 point, as of last time I checked, move up, and primarily that was during Trump's speech.
Yes. It would be Mr. Trump.
It would be. So we're getting a little bit of a bump off of that. How optimistic should we be moving into next week?
Well, I don't think we can be optimistic at all, Hunter, for the very simple reason that over the weekend, we're going to have 2 more days of a waterfall of expanding coronavirus cases. If we look recently, we just had a declaration by the World Health Organization this evening saying that Europe is now the epicenter of the coronavirus outbreak. So it shifted from the east now to the west. So with record numbers of cases in Spain, Germany, Italy, we're just going to see news item after news item of people going down with the virus, and it's going to get very personal very quickly for people. People are going to start to know people who have the illness, and the fear factor is going to add on top of a genuinely scary virus. So it's once in a generation event. So that's why we're seeing, I think, once in a generation type event in the stock markets as well. They're reflecting the magnitude of the times that we're living in. So who wants to be holding risk trades into the weekend, Hunter? I can't think of anyone who would want to be holding them.
I couldn't agree with you more.
Yeah. You know, because you don't know what you're going to wake up to on Monday. So more Fridays than not, since around January the 23rd of this year, Fridays have resulted in a gap down on the following week across a lot of asset classes, and it's for that very reason.
Yeah, and it is kind of the world on fire scenario. I I do truly
Yeah.
believe, even though we have, we were having a little bit of a rough time. I mean, it was a very, very bullish market before all of this happened.
Yes.
However, there were some signs of kind of consolidation. Everybody was waiting for the drop, and then this compounds on top of it. I think it is a perfect storm, but I guess kind of the real question is how long is this storm going to last? And as you stated a little bit earlier, it's based off of a virus, so we don't
Know.
we don't
Although
really know.
I did a back of the envelope calculation, Hunter, which was like, I remember when the virus really started breaking out in Hubei province. It was around like the 23rd of January that it really came on my radar as something that was significant.
Mm-hmm.
It may have developed earlier than that, but that was just when it registered with me personally. And then I looked at the peak. The peak of the cases was about sort of 7 or 10 days ago. So roughly it was about 6 weeks from getting attention to the peak of the virus outbreak. So I was looking, well, that would mean if the same rate of transmission occurred across the rest of the world, it would mean around Easter time, sort of mid-April, we could start to see a kind of peak if the virus followed the same transmission rate. It may not, of course, but I'm sort of working on a rough estimate of about 6 to 8 weeks before we get that transmission peak.
Sure.
So that's when I think I'm looking at it hopefully to be in the back mirror by then. I could be wrong, but I was just trying to forward project, how long might we be in this situation? How long will we be feeling the drag of the virus before we start to see through to the other side?
Sure. And we can see the front side of that wave, but we don't really know what the back side of the wave looks like, how long it actually takes after to actually recover, because no country has actually really recovered yet. So we don't have a timeline. There has been, yesterday was the worst day in the market that we've had since 87.
Yeah.
We've had the biggest jump by the VIX yesterday, jumped by 21 points. Now it's down 11 today. However, massive jump in the fear index. And we'll take a look at the VIX here in just a second. Today it might still be going on. I'm not sure, but Trump did declare a national emergency. He's opening about $50 billion to states and businesses. This is going to free up a lot of money from FEMA, to be able to fight the virus and fight the effects of the virus. From a charting perspective, though, looking at these different charts, I know that you had a couple of charts in mind that you wanted to look at, so let's go ahead and take a look at those in Metastock here. And let me screen a little better. So first off, we have a chart here. Giles, why don't you go ahead and take us through what we're looking at?
Yeah, well, just looking at the gold line, that represents gold. The clue's in the color of the line. So what I wanted to look at was the gold market, because the gold market's behavior has been very, very interesting as the coronavirus outbreak's been going on. And a lot of traders that I've been speaking with, a lot of commentators are trying to work out what's the likely path for gold. Now, one thing I wanted to mention was that historically, when you look at when the VIX is at historic highs, what you tend to get historically is gold trading sideways or lower after a wave of panic in the stock market. So when you see the VIX higher, let me just see. So so here you can see on this date here, I'm just trying to look at the chart now. It's not my chart. On the left-hand side, the furthest left-hand side of the screen, Hunter, could you just tell me what year that is? Is that?
That should be, let's see, are you talking about this right here?
Yeah, that one there. What year is that?
So it's last year, 2019.
So there's a good example. You can see the VIX spiking higher, but then you can see gold trading kind of sideways, consolidating immediately after the spike. So when you look back historically, you'll probably have to do your own research because it's not so easy to see on this chart. But if we go back to present prices, what you see is the VIX has just rocketed to this unusually high level, and we've seen gold sell off. Now, that reaction is not unusual. We tend to see gold prices trading sideways or lower when the VIX spikes. So it's not that unusual to see gold falling. Now, a number of people have been saying, well, the reason gold fell is because traders who were long gold wanted to offset their losing equity positions by cashing in their gold positions. It's kind of like a kind of rumor stroke explanation for gold's fall that's being bandied around a lot. And it has made sense in one way, because a number of times we've seen the stock markets falling heavily on geopolitical virus concerns, but gold's still going lower when you'd expect it to go higher. So the current path of gold down is not unusual historically. However, if you look to 2008 and 2009, and if we look at if we can go on the chart, Hunter, we can see when the stock market fell heavily, 2008, 2009. If you look at the S&P 500, right, that looks like it.
Yeah, that's. Let me just change the chart here. I need to load a little bit more data on this.
Yeah, that's great. Well, I'll just talk you through as Hunter's sort of getting that together. Is when the stock market fell 2008, 2009, that prompted a strong bid in gold. But that strong bid in gold didn't come immediately with the falling stock market. There was a delay. And when you look at the chart, you can see that it was kind of once the stock market had kind of bottomed out. Yeah, once the stock market had bottomed out around 2008, 2009, shortly after you saw gold prices strongly bid. So looking at gold market, I am medium-term bullish on gold, and just looking historically when the VIX is high, when the S&P 500 is falling, there's a slight delay before gold catches a bid. And it's just worth reminding ourselves of the reason for the strong gold bids in 2008 and 2009. And what it was coordinated central bank cutting of interest rates. That's what suddenly made gold such an attractive buy. And of course, that's what we've been seeing throughout this week. We're seeing central banks around the world, literally falling over themselves in order to cut interest rates. And that kind of phenomena is going to be making gold an attractive asset to hold. So that's one thing to really look at, is as we see the stock market falling, once we start to see a bottom in, if those interest rates are still very low across the world, we had the Bank of England cut by 50 basis points this week. We've had the Bank of Canada cut by a surprise 50 basis points today, and they cut by another 50 basis points last week. We've had the Reserve Bank of Australia cut their interest rates. The ECB didn't cut their interest rates. They met this Thursday. We've had the Federal Reserve cut their interest rates by surprise 50 basis points, and the market's expecting a 100 basis points rate cut next week for the Fed's meeting. So the situation for gold is very, very attractive. Once we've seen those stock market falls kind of bottom out, that's when I think we're going to see the attraction in gold. So it's worth looking carefully at the gold market. As it keeps falling down, eventually it's going to find some support. And if the interest rates are still low across the world, it will become a very attractive asset, especially when you look at how low bond yields have been, with the whole of the US yield curve underneath 1 for the first time in history. So where do investors look to get their alpha? All of a sudden, gold, which doesn't normally give you anything for holding it, in effect, sometimes you have to pay. If you physically hold gold, you've got to pay for the storage. Mm-hmm. So in that sense, gold is not attractive, but in a very low interest rate, low yielding environment, it does become interest. Does that make sense, Hunter? That kind of perspective on gold. What have your thoughts been on the gold market and how that's been relating to the falls in the S&P 500?
Well, and it's interesting you should ask that. I pulled up a chart here. We're looking at third quarter 2008, fourth quarter 2008, late or early 2009 here, and we have that VIX spiking. We have gold losing a lot of momentum, the market dropping.
Yeah.
But then slowly, as the market continues to drop, we have gold moving up here. What's interesting is I kind of asked the question a couple of weeks ago in our international market recap, and I've been very, very curious about gold lately, just due to the fact that on a very small scale, as we move into summertime, typically people will take their money out of stocks and they'll put them into gold and silver and things because they don't want to actively trade. So we typically, moving into those spring, summer months, gold prices tend to surge just a little bit.
And you've got the Indian wedding season as well, Hunter, that helps around August. With those Indian weddings, you get a lot of physical gold demand, and that helps boost the prices as well.
Yeah, and it's something that, I was curious how the gold market would be affected based off of all of this. And, I thought that if the stocks would be falling like a fire sale, like they are right now, that people would be buying a lot of gold. I think gold is going to be a leading indicator, though, moving forward. Kind of, as people start to invest more, they'll start investing into things that are a little bit more stable typically, and I think gold is going to be one of the first things that we see as a leading indicator for the rest of stocks.
I think that's a really, really insightful way of looking at it, and I think it is going to follow that path, because when you look back historically, although we see gold as this asset that investors rush to during times of crisis, there seems to be that slight delay. So I think thinking of it like a leading indicator of recovery is actually quite helpful. And it made me think, when you were talking, Hunter, about the gold-silver price ratio, because the gold-silver price ratio is at record high, at 20-year highs now. The last time I looked earlier this week, I think it was around 97, the gold-silver price ratio, about a 20-year high. And that means that gold is just much more expensive in relation to silver. So it's worth reminding yourself that, because if gold starts moving and you think you've missed the boat, silver may not have left the station. So you might still find opportunities to get into silver, because the gold price relative to silver is very, very high. So silver does offer good value for buying in longs. And, you may even want to buy longs. Some investors will be looking to get in there early, so they've got that really bargain silver price before gold takes off.
Yeah, and a good example, going back to this fourth quarter and early 2009 scenario, as I push forward in the chart a little bit, again, we do have this high fear, we do have this massive drop in 2008, and then we see gold climbing all the way up to, and as you can see, it is a leading indicator here. We had a little bit more of a drop, but until the market caught up to it, we're looking by July, so midsummer of 2009, gold did act like that leading indicator. So
very insightful. That's a very good observation. I hadn't seen it like that, Hunter, until you pointed that out tonight. I think that's a very helpful way of looking at it.
Yeah, it's interesting. I think kind of the question now, though, is where if we look back at 2008, this market crash, where is this part of the chart? Like, where are we in this part?
Where is it? And I don't think we're there yet, because you can only see the viruses spreading further. You can only see more cases. I mean, you look how quickly Italy developed, and I was looking at the death rate in Italy, and it's around 7%.
It is. Mm-hmm.
Now, I know the Italian population is the oldest population in Europe, and the elderly are most susceptible to coronavirus, even though everyone's susceptible. The elderly are most susceptible to it, specifically in terms of mortality. Mm-hmm. So a 7% death rate. It is an overwhelmed health service. Once you start getting overwhelmed health services on multiple cases, then people aren't going to want to go out to go to work, are they? Because even if they are fit and relatively young, they're going to be thinking as we are as a family, thinking, oh, but what about granny? What about grandma? What about grandpa? Sure. We don't want to expose ourselves in case we then bring it home. So I think that's going to mean people are going to, not going to be wanting to go to a lot of social events. I was just picking my son up from tennis the other evening at Hunter, and I was outside a cinema where we were picking up my children from their tennis event, and the cinema was empty. Mm-hmm. And I thought to myself, well, how long can you run an empty cinema before you start sending workers home?
Yeah.
And then you're not getting your pay. You're not getting your pay for the whole month, 2 months. How can you survive? How can businesses survive? Sure. And that's what we're trying to grapple with, is how do you kind of blank out 3 to 4 months of an economy?
Yeah, and the ripple effects are going to be long time to recover from this, especially if the peak and the fall off of this virus is not, if it's not short term. We are talking about, like you mentioned, people off of work for a month or 2 months. We've seen a ton of ripple effects from this so far. People, businesses shutting down for the most part. We've seen, in sports in the U.S., we've had the NBA shut down.
Yeah.
We have had, soccer, football, as it should be called. The Olympic friendlies have been canceled. Golf, the Masters. We've had all these major sports shutting down systematically within the last few days. This is coming down the pipe even to where locally, where I'm at in Utah, where we have schools shutting down, where we have offices switching over to working from home, and
yes,
it is very frightening at the speed that this is moving. Hopefully, it's an indicator of how fast it's going to move away, as well. We hope. As we start getting to the point where we're on the backside of that wave, do you have any industries that you are looking at? Maybe some different instruments that you are looking at aside from gold that would be leading the charge, driving this market back up?
Yeah, that's an interesting thing. I think I've been so focused on what's driving the market down that I haven't looked on the other side of the wave yet. One thing that I have been noticing, though, that I think is quite an interesting thing that's worth looking at, is the way that the market's trying to work out how it grapples with a country that uses monetary policy, so the action of the central bank, and fiscal policy, the action of the government. And I thought the pound, when it had its rate cut this Wednesday, was a really, really interesting case study. Because in this case study with the pound, we saw, if we could go on the intraday chart, like maybe the 1 hour chart, and get to a Wednesday, that would be great. You're doing a great job with the charts there, Hunter, by the way. Thank you very much for being my hands.
No worries at all.
Yeah. If we look to Wednesday, we see the way that the pound moved is that there was a sudden spike down in the pound when there was a 50 basis points rate cut. I think it's that black candle with the wick on in between the 11th and the 12th on your chart. I think it's there around 1.2. Is that 1.285? Yeah, that's it. So you see that wick to the downside. That was when the Bank of England cut interest rates by 50 basis points. And so when you have an unexpected bank cut like this was slightly more than the market had been pricing in for the Bank of England's cut rates. So you typically expect to see this candle black, and then the next candle black, and then the next candle black. You'd expect to see quite a strong reaction in the pound, but we didn't. We saw the spike, profit taking, buyers coming in. Now, the reason buyers were coming in was because the UK government was having its budget, and there was an anticipated meeting when the UK would be announcing fiscal measures. So there was something like a 7 billion package fighting coronavirus. There was like cash grants for small businesses. There was a £500 million hardship fund. There was sick benefits for people who had coronavirus. There was a whole range of fiscal stimulus. Now, I remember at the time thinking I really wanted to short the pound, but I didn't hold a short position because I was unsure about how the fiscal stimulus was going to work. Now, if you fast forward, just a few hours, you can see that eventually the market focused on that 50 basis point rate cut. So I know we had some strengthening dollar around this time as well, which helped the pound fall. But what was interesting for me was the fact that you had the monetary policy and the fiscal stimulus at the same time, but the market wasn't reassured that that was going to be kind of the end of the near-term woes for the pound. And it was sort of focusing on the interest rate cut, which is kind of as it should be in a classical model. It's the interest rate which drives the currency. So that was the question in my mind. How would fiscal stimulus and monetary policy working together impact the currency? And what we saw that there is with the pound is that the market went with the interest rate. And then if we look at the euro, we also had the ECB with their central bank meeting on Thursday. And it was just very interesting to see that when the central bank met, now the ECB didn't cut interest rates, but they did maintain their kind of call for fiscal stimulus. Christine Lagarde famously, I quite like the way she phrased this. She was asked, are you a bear or are you a bull? And she said, no, she's an owl. So she's trying to be wise. And I think it was wise of her actually not to cut interest rates, because negative interest rates, especially below negative interest rates, I think are a limited value. But once again, she made the call for fiscal stimulus. She introduced a new wave, about 120 billion euros of quantitative easing. And as a result, we saw the euro selling off. So fast forward this to the Canadian dollar today. Look at the CAD yen. This is what I find interesting, which might be an interesting trade for Monday, which is we've seen the CAD has gained, even though the Bank of Canada cut interest rates. You hear around, do you see the 77.10, the 77.10 area? That's it. On that candlestick there, I think that's where we got the 50 basis points rate cut. We've then had some strong bids into the CAD and the yen since the interest rate cut. Now, what I'm expecting is this to roll back over and roll back down. Prices kind of fill the gap from Monday. There's a very large gap that price is currently sitting in now. If you just scroll a little bit to the left, you'll see that gap from Monday. That's it. Yeah. So you can see that gap there. So kind of that gap's just been filled. But again, what I'm expecting is the market to go with the interest rate cut of 50 basis points, to ignore the fiscal stimulus, or if it does come, maybe another spike and then a drift back down. So just based on what we saw from the pound, Bank of England, what we've seen from the ECB, and what we've seen for the Bank of Canada, we have the bids in the Canadian dollar now, certainly because of the announcement from President Trump that he wants to use the really cheap oil prices to bump up the oil reserves in the US. So there's a sudden run on oil, there's a sudden run to the upside on CAD with its close correlation with oil. But longer term, as of Monday, I'd expect this to drop down, possibly gap lower is what I'm expecting, given the fact that it's trading with the yen. And as a risk off currency, if we're going to see more coronavirus cases over the weekend, we should see that gap to the low. So I think that's an asymmetrical risk going into the weekend because of the likelihood of the coronavirus getting worse and Japanese yen strengthening and the market focusing once again on the bigger picture rather than the quick bump of the of oil being bid.
And I agree with you there. One thing that you mentioned that kind of raised my eyebrow a little bit was if we're taking a look at, let's see, the first one, I believe it was the euro. Was it
Yeah.
the pound or the euro?
The pound was the first one with the Bank of England rate cut on Wednesday.
Okay. So we were looking at the initial move right here. This is the move that we're looking at.
Yeah.
When they cut rates, you had a very bullish bar. You had another bullish bar.
Just before, when they cut rates, you had the bearish bar that was bought up. It's the one just next to it.
Mm-hmm.
You see that? Yeah, it's that one there, Hunter.
Mm-hmm.
That was the rate cut candle.
So the rate cut, and then with the financial stimulus in it, do you think that U.S. markets are going to do something very, very similar, because we do have a stimulus coming in right now, with Trump releasing the $50 billion, with FEMA getting involved, with all of this stuff? Do you feel like this last bar, today's bar on the Dow, is a little bit of false inflation on that, false hope?
Yeah, exactly. That is my observation, and I was using the Bank of England as the first kind of case study, because the fiscal stimulus that they announced was excellent. It was like a multi-billion pound package that was really, really good, and there was very few bitter pills in it to swallow. It was designed to appease the markets. But then seeing the market reaction for me was that case study of when monetary policy and fiscal stimulus collide, which one kind of wins out. And for my mind, it was the monetary policy that was the big driver, which was the rate cut. Mm-hmm. Now, I mean, these are early days and these are uncharted waters, but it was just interesting to see that observation on the pound on Wednesday.
Yeah, that's interesting, and I agree. I think that the U.S. we're I think that our market is going to follow suit. We're looking at an hourly chart on the Dow today. Obviously we gap down, a little bit, a lot on the 12th, but right here, there's a little bit of indecision, and then right here, this hourly bar at from 3 to 4 o'clock. That's right when this announcement came out.
Yes.
And kind of leading up to it a little bit. And as Trump spoke, you could actually watch the Dow tick up. And that's a little worrisome, because I don't think that that's really based on much. I feel like that's a little bit of false inflation based off of hope, off of using words like FEMA, national disaster, funds being injected into the market, $50 billion. Kind of buzzwords like that, falsely inflating the market. I think we could gap down again on Monday. What do you think?
Yeah, that is exactly the point I was making. I think it's exactly that, and it's, I think it all started with Mario Draghi with the ECB, when there's a central bank, they've got negative interest rates. What do? He's purchasing quantitative easing. He's got these TLTROs. He's doing everything he can to kind of inject liquidity and make it easy for the financial system to work. And he basically says, well, that's it. We can't do anymore. We need fiscal stimulus. So from that moment on, I was thinking, well, how does that work? How does monetary policy and fiscal stimulus together, how does the market react to that? Mm-hmm. And I think we're going to start to see the answer to that question now. We saw it with the pound, and the market was like, no, we're going with the monetary policy. We're not enamored with this fiscal stimulus, even though it was an excellent package. So I think we'll see the same. I think we'll see a gap down on the Monday, because cold hard reality hits on Monday, and the virus is still here, and you can't keep writing the virus a check.
Right. You wake up Monday morning, everything has been the same,
Exactly.
and we're still in damage control.
We're still in damage control, but things are now worse.
Right. Exactly. Let's take a look at a little bit other news. Let's take a look at Russia versus Saudi on the oil. How do you stand on oil right now?
It's a bearish market. The big picture with oil is we've got three main problems. One, the market is oversupplied. Two, demand is falling because of the spread of the coronavirus. We had the International Energy Agency saying that demand is going to be kind of a near a recent record low for the coming year. Mm-hmm. So demand is low, supply is high, and we have Saudi Arabia engaging in a price war because Russia are not wanting to, agree to production cuts because they can balance their economy when oil's at $40 a barrel. Mm-hmm. Saudi Arabia need oil to be $80 a barrel. And so Russia are quite happy with price, knocking around 40, 45. It's not a problem to them. Mm-hmm. And so they don't want to interfere. So those three factors just keep saying that oil will be sold on the rallies. There's only one thing that I think that will boost oil at the moment, Hunter, and we saw that today, which is countries saying, gosh, oil is so low, we'll top up our reserves.
Sure.
So the next country to watch, US, President Trump said he'll do that today. So we saw the sudden spike in oil. Mm-hmm. We'll also possibly see China say the same thing. That, with oil prices being so low, we'll top up our reserve. This is a great time to buy. So I can see that would provide some maybe a temporary bottom in oil. But every time price is going to rise, it's going to find sellers at higher prices because of the big picture hasn't changed. So that's the broad picture of how I'm seeing oil at the moment.
Well, and oil had the largest 1 week loss since the market crash in 2008.
Yes.
And U.S. is cutting their crude to 1 million barrels per day. Again, you bring up that price versus demand, that production versus demand, and it's interesting how this is going to affect. Because, in the U.S., we're going to start moving within a couple of months into our travel season, which typically means we're going to see a spike in gas prices.
Yeah. Not this time, but you can take those road trips to your heart's content.
Yeah, exactly.
Yeah.
And on top of that, the fact that no one wants to take road trips. The happiest place in the world, Disneyland, is shutting down. So
yeah, who wants to get sick by going to Disneyland? Exactly.
It's true. So I think that the trickle down effect is going to hit every single possible market, and Russia versus Saudi Arabia does not help. The oil prices. It helps us for gas prices, but we don't want to go anywhere.
Yeah.
Yeah. Anything else that has been catching your eye lately that you wanted to take a look at?
Yeah, let me think. Australian dollar, US dollar. Aussie US dollar is quite an interesting point. If we just look at that on a monthly candlestick, we can just. I can just see more downside for the Australian US dollar because if the coronavirus gets worse, if the situation continues to deteriorate, I'll be expecting the US dollar to start acting as a safe haven as investors sort of rotate out of everything and into cash.
Sure.
A lot of that is going to support the dollar. So the Australian dollar, obviously it's closely linked to global growth with its copper exports, its iron ore exports, and it's a key commodity currency. So when we're in a risk-off environment, the Australian dollar gets sold. So I quite see more downside in the Australian US dollar currency pair with a strengthening US dollar and a weakening Australian dollar. And any sort of retracements look good opportunities for sellers, particularly as the coronavirus, as it gets worse and expands. So I think we are looking for more Australian dollar, US dollar downside. So that is one chart that took my interest earlier this week, expecting those sellers to be at market and at pullbacks.
It makes sense. We are, in the U.S., we are rotating everything to under the mattress, basically.
Yeah. Yeah, exactly.
Looks like we had a question on the YouTube side. Let's get to that.
Yeah, great.
Yeah, Jondra91 says, do you think we are at the bottom of the U? A few friends of mine were asking. I don't think so, but I don't have any experience. I think he means the bottom of the pattern U. I'm not sure. what he means by
Yeah,
that
I
exactly.
think are we at the bottom of the lows in recent prices, like in the S&P 500, the Dow? I think that's what he's meaning. Are we at the worst of the falls? No, is my opinion. If I've understood the question correctly, because you can only see the virus expanding and the implications escalating. And I think, Hunter, you pointed that out very well during our conversation, that the knock-on consequences aren't fully realized yet. And it's very hard to foresee consequences, let alone unintended consequences of the current situation. So I think we have more further to fall. I think we have another down leg at least in this fall. So that's certainly my anticipation. I don't think we found a bottom yet.
I'd have to agree with that. Obviously I'm not the professional trader here, but just based off of looking at the charts and understanding some of the factors involved, this is just, again, if we look at it as the wave, and everybody's talking about the limiting the spike and the wave, etc. We don't know what the fallout is yet and how long those repercussions are going to take. We only know hopefully the extent of the top of the wave at this point. We don't know if this is going to last for 2, 3 months, 6 months, or less, hopefully. But again, I think that we have been a little bit false inflated today with the market, and once that honeymoon period kind of wears off over the weekend and more people start getting fevers and more industries are affected, I think that again we're going to continue in a bearish trend, which is very unfortunate. To lighten the mood, though, I think that with the market going down this much, everything's at a fire sale. I think that once we do start getting some actual bullish momentum, I mean, it's take all the money out of the mattress and buy everything you can. I feel like that's going to be the climate, and it is going to raise just as fast as it dropped after a little bit of consolidation. What do you think?
Yeah, I think it's a good point, and it's good if we just zoom out and we took a 3 to 5 year perspective, a sort of a longer term investor perspective. This is potentially when a lot of money could potentially be made, because you're buying in at these really rock bottom cheap prices. So I think once we start to get a sense of a bottom in, one approach is to scale in slowly as we move down. And that scaling approach means that we've sort of got an average price rather than being married to one particular price where we might be wrong. It's better to sort of scale in, a couple of 200 or every 300 points, and that way we can average in. And over a 3 to 5 year window, you'd expect the coronavirus to be long gone in the distant mirror, and us to have a vaccine by then, and it to be no more serious than getting a flu jab. Sure. So I think, Hunter, you have an excellent point that there are some potentially good bargains for the longer term investor. Obviously not for the short term trader who's using leverage. Agreed. This is the wrong time to be trying to guess a bottom. But for that longer term investor, it could be a perfect time to find a bargain.
Yeah, I mean, this is buying the ETF in 2017, basically. The Diamond ETF in 2017. It's going to prove to be a wonderful opportunity, but I think until then, like you said, it's going to be good for long-term investors, but anyone that is leveraged right now and wants to go long,
no.
Hang out for a little while. Cool your jets a bit.
Exactly.
Trying to catch a falling knife is kind of what you're doing at that point. Any other questions on YouTube?
Chandra asks again.
Okay.
Turn on my mic. How often do you guys stream? I like your guys' style. LOL. Very calm. Well, thank you, John Dredd 91. I have to give that credit to our guest today and also Hunter, but I would like to point out that we do this market recap every Friday at 4:30 p.m. Eastern, as well as generally a couple times a week we do stream other guests or ourselves. And if you want to find out more about that, you can go to metastock.com/events or /webinars. This particular event, we only stream live on YouTube and Facebook simultaneously. So the best way to catch this one is just show up on YouTube at 2:30 local, 4:30 Eastern.
Or subscribe.
Or subscribe and hit the little bell and you'll be reminded.
We need to do the YouTube things. We need to do the subscribe now.
Yes, that.
Click
Yeah,
the
there's that.
notifications.
There's that. Yeah.
All of that stuff. Thank you very much. Like Greg said, we do this about once a week. And we normally have, we used to have a green screen here, but we got rid of it way too fast because otherwise there'd be, buildings on fire behind me and asteroids hitting, and we don't do that anymore. So that's why we appear so calm. Yes, down in front, Greg.
So we have a lot of viewers today, but I think they're a little shy. Again, Jondra91 says, I'm brand new to investing. I'm looking to buy stock in Disney airplanes and maybe Uber and Lyft. I guess that's more of a statement than a question. Do you have a comment, a general comment on those ideas?
Well, only airlines, a lot of them are about to go potentially bust. So buying into airlines is a very risky prospect. I mean, we had Flybe in the UK go bust. We've had, is it South A Pacific or China Pacific? They've got first half earning warnings. We've got the French government wanting to step in to help Air France. We have the Dutch government wanting to help KLM Airlines. We have British Airways announcing job cuts. We've got UAE Air Emirates under pressure with lots of air routes being cancelled. So I think buying into airline stock is, wow, you've got to be very brave to do that. Given how long is the virus going to carry on, which airlines will survive? Some of them are going to end up being bought by governments at this rate. There's going to be government shares in airlines. Now, you could take the view that in the UK, that the UK government won't let British Airways sink, and it will nationalise it before it lets it sink, in a similar way that it did with Lloyd's and RBS. So when the banks were about to go bankrupt, the UK government stepped in, and then the idea was that the banks would sell back the government shares as they reach profitability. So you could take that approach, but it's a risky approach because sometimes governments let airlines fall, like they did with Flybe in the UK. They just let that airline collapse. So I think airlines is a risky investment right now. Hunter, I don't know anything out of the list that struck you.
Yeah, airlines. Again, we're trying to find the bottom. It sounds like we're looking at we're trying to buy Amazon at $2 basically. It's kind of that mentality, and it's understandable. And the guys around here, we all have lists of some stocks that we're looking into. Transports,
cruise ships,
cruise ships. But you start looking at these things. Delta came to mind because it came out that Delta and some of the other major airlines here are looking to get some government assistance during this entire time. Delta is not something that I don't think that the U.S. would let Delta fall. We would treat it like a Fannie Mae, Freddie Mac situation. We would treat it like a Ford company situation. We're very good at bailing out large corporations on this side of the pond. But
same this time as well. We're looking after the big boys.
Yeah, but it doesn't make it a great investment, I don't think. You look at Lloyd's,
and the share prices have never recovered from the lofty heights that they were. And, yes, they sold back some of the government shares, but they're still sort of pretty depressed. And banks have never really been doing very well with interest rates being so low. Their sort of main area of profitability has been hit, and they haven't really recovered across all of Europe.
I think some of the stocks that might lead the charge, just because of the way that they're run,
cruise
possibly. Definitely not cruise ships. And the cruise ships are a great point because they're selling so cheap right now. You could probably get on a cruise 2 for 1 right now.
Well, except
they're
they
shutting
canceled
down.
all of them. Yeah.
Here's the thing: is again, you're trying to catch a falling knife. You're really trying to catch a stock right at the bottom. You don't have to necessarily do that. Plus, the fear factor, the back end of this wave that we keep talking about, it's going to be long-lasting effects of, okay, well, the virus is gone in a year, but do I really want to hop on a cruise ship next year for fear that it'll happen again? So I think that some of the companies that, some of the industries that are going to lead the charge are these large tech companies, the software companies that have the ability to have business as usual because of all of the tools that are at their beck and call. They have the ability to work from home. They have the ability to hold all of their meetings at home. They have the ability to service their customers just like normal from home.
And their products are online, so everything is digital.
Exactly. And as more and more people push, I think that this is going to be possibly a good indicator of where industry is moving as we see the need to be able to do everything online so that if this happens again, it doesn't shut down the entire economy. Cloud-based companies, cloud storage companies are, I think that they're going to be really beefed up. I think that they're going to be a good buy long term. I think they're going to be some of the first companies to turn around because when you work from home, when a company's working, have a lot of their employees working from home in digital workspaces, et cetera, they need cloud storage to store all of their information. I think that those companies are going to be left a little bit less harmed by this giant dip, but long term, definitely good buys. What do you think, Giles?
Yeah, I think that makes a lot of sense. That they're best placed to ride out the storm. Yeah, absolutely.
YouTube is starting to ask some questions. So
Yeah, they're starting to perk up a little bit.
Hi guys on YouTube. Perk on up.
Toffer asks, what happened after similar bounces in 87 and 2008?
2008, we kind of looked at. Giles, what's your way in on? We were actually using 2008 as an example a little bit earlier.
Yeah, and that's when you were mentioning about gold being a leading indicator of the way out, which I thought was a very interesting perspective on that. And just going back to that, we had, and the other reason for gold's, attractiveness was coordinated central bank interest rate cuts, which is exactly the environment we're seeing now. Coordinated central bank interest rate cuts. So, for me, that as long as those central bank rate cuts keep coming, then the situations for gold to be bid is ripe once we get some kind of bottoming out, once we're some way over the wave.
Yeah, and again, here's the chart of fourth quarter 2008. We talk about gold, possibly being a leading indicator, being very strong. If we look at the drop here, which I think is kind of, overall market drop, it took quite a while for the market to recoup. It took, where'd my line go? It took about 2 years for the S&P to really catch up. That doesn't mean that a lot of stocks weren't recouping faster than that. But again, and gold was up the entire time. So that's an option for you. I could probably look at 87, but I feel like we're going to have a really similar result here. Let's scroll back. Let's see. Oh, passed it. 87, here we go. We don't have VIX data for 87, but here's the massive sell-off in 87. This actually recouped quite a bit faster. Let's look at the high here. Well, not quite a bit faster. It's about 2 years.
That's about 2 years each time. That's interesting.
So again, and you have this consolidation movement, and then you actually have the overall trend starting to get back to bullish.
Yeah.
So, as far as an overall market perspective, it could take 2 years as we sit right now. But again, we're throwing darts at a dartboard right now, to be honest.
Yeah, we don't know exactly the situation, exactly how it's going to be this time.
Yeah. Greg, another question?
Dan666 Mega asks, and I'm assuming this is about possible sell. I'm sorry, because we're talking about possible positions to get into a while ago. He's asking, what about banks?
Good question. I'll defer to Giles.
Yeah, the situation with banks is that a lot of them have been trading like quite a good price to earnings ratio, and so a lot of people have been talking about, oh, European banks, they're in a really good position. But each time banks kind of hold out that offer of a really good bargain price, interest rates seem to be continually cut. So one of the prime ways that a bank makes money is from interest rates. So it's getting harder and harder for banks to make money with interest rates being so low. And also we're seeing a number of new players entering the market who are doing things like offering commission-free share trading. Like I think of the company Share Trading 121, totally commission-free. We have companies like TransferWise, Revolut offering commission-free foreign exchange for businesses. So I think it's a very competitive market for banks. We're seeing a lot of digitalization and innovation in the financial sector. So I think it's quite hard for traditional banks to keep a foothold. So with interest rates being low, I mean, the outlook for banks is not great. I think what you'd want to see before having confidence in banking stock rising is to see a situation where we have rising interest rates. But look how long interest rates have been low, and interest rates are only getting lower. Mm-hmm. Mm-hmm. So I just see an economic situation where we can't afford to raise interest rates because no one will be able to afford the repayments. I mean, people of my generation and younger have never known high interest rates. When I was a young boy, my parents told me that they were paying interest rates of about 15, 16% on their mortgage. I'm paying something like 1.7 or 1.5% on my mortgage, a fixed term. Mm-hmm. So when you consider that, I mean, you couldn't just jump a 10, 12% interest rate mortgage on people because they wouldn't be able to afford the repayment. So I just see us locked into a low interest rate environment. And as long as that is the case, it's very hard for banking stocks to really do well. And I think some of the things that Hunter was saying earlier about some of those, some of those tech stocks, your Facebook, your Netflix, things that have things online, I think that they're more attractive. Hunter, would you agree with that kind of synopsis?
I would agree 100%. You mentioned brokerage and trading fees, et cetera. As more and more platforms out there, more and more brokerages offer zero trading. That took a little bit of a hit this last week because the major one, Robinhood, basically broke for 2 days, 3 days. They've been leading the charge on zero fee trading, and I can say that I was personally affected by that and not a very happy camper. But that synopsis of technology is taking away the primary ways that banks make money. I think it's incredibly accurate. The interest rates are low, and like you said, the populace cannot afford the interest rates to be higher, especially at this point and kind of what we're going through now.
Absolutely. And if you look at the average Joe isn't just working one job, they're working one or two jobs plus a little bit of freelancing on the side. Mm-hmm. So it's not a situation where we've got people sort of shirking. We've got people needing to do multiple jobs simply to meet the repayments for their bills.
Basic requirements, right?
Basic requirements. So in that kind of environment, we're so up to the max which is what this virus is exposing, really. That as an economy, we're literally living hand to mouth. Very few people have savings. Very few people can afford not to have 1 or 2 paychecks a month. And that's the real scary thing. And I can't remember who it was who said that, the world's only 4 meals away from anarchy. And I think, we've got these toilet roll shortages all over the world. We've got people, buying who knows whatever they decide that they desperately need. And before you know it, you'll have people falling out with each other, and you'll have tensions running very high. So I think that's the scary thing about this coronavirus, is it's going to expose a base nature and really expose how vulnerable we are as a society. And I think banks are only going to take the brunt of that.
Agreed. Overall, I think the overall synopsis for this is, yes, it's a very rough time right now for the markets. It's a rough time to be trading, especially leveraged, especially if you're trying to catch a falling knife. Stop doing it.
Yeah.
I think kind of the overall advice here is, yes, it will reach. It will reach a bottom. We will get to a point where we have some consolidation and start moving up, which is really the time that you're going to be taking the cash that you have in the market right now and dumping it back into stocks at half the cost, 3/4 of the cost of what they were 2 weeks ago. Okay. So, stay calm out there. The world's not on fire. It's just burning a little bit. Not too big of a deal. So, I think with that, we're gonna get on wrapped up. Giles, my friend, it's been a pleasure. I appreciate you coming on today and sharing your thoughts with us.
You're very welcome, Hunter. Thank you very much for having me. It's been a lovely hour and been really stimulating, looking at a very hectic week in the markets.
Yeah, and for those of you out there that want to hear more from Giles or have some more questions, we're going to put a link into the chat box that you can click and be able to contact Giles and get more information kind of on how he trades and the tools he uses, etc. All the tools you saw today are metastock oriented. There's our shameless plug. Giles, again, thank you so much for taking an hour out of your evening, and stay safe out there, and I hope you have stocked up on toilet paper.
Yeah, we got plenty. Cheers, Hunter. Watch out for those cryptids, Greg.
You got it.
We'll wish Greg good luck on those cruise ships. Thank you, everyone.
Send us a postcard, Greg.
Yeah, exactly.
I'm not going to get on one.
Don't bring anything bad back.
Hey, don't knock it till you've tried it.
Everyone out there in the audience, thank you so much for joining us today. I hope you learned something.
Yeah.
Again, we don't think the world's on fire, but just be reasonable with your toilet paper purchases, with your water purchases, with your stock purchases. Be smart out there. Thanks for joining us today, and as always, happy trading.
Thanks, guys. Thanks, Hunter. Bye, guys.
Cheers.
Bye, everyone.